Now let's examine how organizations evaluate performance when responsibility is divided into cost centers, revenue centers, and profit centers. As organizations grow, they decentralize decision making, which means different managers control different parts of a business. Because of this, we must evaluate managers differently depending on what they actually control. The central principle in responsibility accounting is fairness. Managers should only be evaluated on the elements of performance that fall within their authority. If evaluation systems are not aligned with authority, we risk discouraging good decision making. By the end of this section, you should understand how performance reports different across cost centers, revenue centers, and profit centers, and why those differences matter. A cost center is a segment of the organization that incurs costs but does not directly generate revenue. Examples include human resources, accounting, IT, maintenance, and production departments in manufacturing firms. These departments are essential to operations, but they are not responsible for generating sales. Because cost center managers do not control revenue, they are evaluated based on cost control. Specifically, we compare actual costs to budgeted costs and determine whether they stay within acceptable limits. It would be unfair to evaluate a cost center manager on profit because profit depends on revenue decisions they do not control. Cost center performance reports compare actual costs to budgeted costs. However, not all costs are equal. Some are controllable by the manager and others are imposed from outside the department. For example, a department manager may control staffing levels and supply usage, but not building depreciation allocated by headquarters. Therefore, responsibility reports must isolate controllable costs. This reinforces accountability and ensures evaluation systems promote motivation rather than frustration. Responsibility reports focus strictly on controllable costs and compare them to budget expectations. If a manager exceeds budget on controllable items, we investigate the cause. Was it inefficiency, unexpected demand, or poor planning? If a cost variance is due to an uncontrollable allocation, it should not be included in performance evaluation. The goal is improvement and transparency, not punishment. In this example, we evaluate a department using a responsibility report that includes only controllable costs. When analyzing variances, we ask two questions. Was the variance favorable or unfavorable? Was it within the manager's control? This analysis ensures that accountability aligns with authority, which is foundational to decentralized organizations. A revenue center generates sales revenue but does not control production costs or major pricing decisions. The classic example is the sales department. Sales managers focus on selling volume and managing selling expenses. Their performance evaluation focuses on total sales generated and adherence to direct selling budgets. Again, evaluation must match authority. Sales managers cannot control factory efficiency, so they should not be evaluated on it. Sales variance measures the difference between budgeted revenue and actual revenue. If actual revenue exceeds budget, the variance is favorable. If it falls short, the variance is unfavorable. But total sales variance alone does not tell us the reason for the difference. To understand performance, we break total variance into two components: quantity variance and price variance. Let's consider the Willis example. Budgeted sales were 1,000 units at 200 each. Actual sales were 1,075 units at $190 each. Total revenue changed, but why? We sold more units, which increases revenue. However, we charged a lower price, which reduces revenue. Variance analysis separates these two effects so management can understand what actually drove performance. The sales quantity variance isolates the impact of selling more or fewer units than planned. We calculate it by multiplying the difference in units sold by the budgeted price. This tells us whether volume performance was strong or weak, independent of price changes. You can see in this sales quantity variance example, we set the price constant at a budgeted $200, so we can isolate the difference between actual sales in quantity versus budgeted. Sales price variance isolates the effect of charging a different price than expected. We multiplied the difference in price by the actual quantity sold. This reveals whether revenue differences are driven by pricing strategy or market pressures. You can see in the sales price variance example, we set the quantity constant at the actual quantity level of 1,075 units. That allows us to test for the difference in pricing of $190 per wheel, which was the actual price, compared to the expected or budgeted price of $200. Here's an illustration of a two-column approach to analyzing sales variance analysis. You can see that on the left side of the column, we set sales quantity constant. That allows us to isolate the sales price differences between column 1 and column 2. In the difference between column 2 and column 3, we set the price constant at $200 per wheel. That allows us to isolate the sales quantity difference between column 2 and column 3. Taken together, both columns represent the total sales variance. In this case, the actual sales of $204,250 was higher than the budgeted sales of $200,000, so we had a favorable sales variance. Now let's do learning activity 11.3. Compute the sales variance, the price variance, and the sales quantity variance. Pause your video here and complete the exercise. Check your answer with the solution provided in the back of Chapter 11. Now let's talk about profit centers. A profit-centered performance report typically includes sales, variable costs, contribution margin, direct fixed costs, and division profit. If division profit differs from budget, we analyze which components cause the variance. Profit center evaluation is more complex because managers control multiple layers of performance. For example, a division of a corporation or standalone fast food restaurant might be a profit center. A manager's performance evaluation is based, again, on sales, the variable cost, and the fixed costs. Fixed costs must be carefully classified. Direct fixed costs are traceable specifically to a division. Indirect fixed costs are shared across the organization. Traceable fixed costs include direct costs plus any reasonable allocation of shared costs. Proper classification ensures fair evaluation and avoids distorting division profitability. Here's a profit center performance report for Willis Custom Wheel Company, where we can compare the actual performance versus a flexible budget to arrive at a flexible budget variance for Willis Custom Wheel for the first quarter. You can see that net sales were below expected, a 6.7 unfavorable variance. Variable costs were above expected. Of course, that's unfavorable because we would hope that costs would be lower. Together, that resulted in a 10.8% unfavorable variance in contribution margin. We controlled our fixed costs, but only slightly better than expected, resulting in an overall unfavorable variance of 15.3% for the division when evaluating overall profit.